Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we have Steve Johnson from Forager and Jeremy Bendeich from Avoca. Welcome. We are talking about resources. The country was flying on the back of the resources boom a few years ago, and it's been nothing but down since. Are we at the bottom yet? Well, let's find out. Steve, what do you think? Is it time to dive back into the resource sector? It's a big area.
We're not at the bottom in terms of industry profitability, but the stock prices are very interesting, and the psychology in the space is very interesting because there's a lot of people out there saying, I would not touch this at any price. And I think that there are pockets of interesting value out there for those prepared to take a long-term view.
And what is not in that pocket? Is there anything you wouldn't go near?
Yeah, I'm very nervous about things with a lot of debt on the balance sheet because I think it's going to be a very difficult period and you need the balance sheet to get through that and out the other side. I think you need to be very low down on the cost curve for the same reasons. We need to come out the other side. There's capacity needs to come out of the sector and you want to be the one that's left standing at the end of that.
Last man standing.
Yeah, absolutely. So we are focused on businesses that are at that end of the spectrum, and I think some of the services providers as well are interesting, but again, debt-free, strong balance sheet, enough cash flow to get through this period.
And there's not many of them. Jeremy, you're pretty optimistic normally. You got a little bit of light to shine on this?
Not today. I mean, China has devalued their currency today, which is telling you that things are really not very good in China. That's one of the last steps you do from a macro policy tool. And that's signalling that there's a pretty tough outlook for commodities, especially the bulks. Anything that China basically produces, coal, you don't want to be in because there's just an excess of supply in the market. If you look at these guys, the capital that they've spent and invested, that's why we had a boom in Australia. We had a capex boom. Mm-hmm. And that's all turning into production.
So the bulks are no good.
Yep.
There's too much supply for the ongoing demand. Is there any commodity that looks okay?
I agree with Steve. There are pockets of commodities out there, perhaps copper, where there's some medium-term constraints on supply, and potentially also nickel, as nickel is at such a low price now that it's got to drive a lot of supply out of the market. And if you're in, as Steve said, a low-cost producer that can survive through the cycle because it doesn't have too much debt, you might come out the other side. But it's timing this downturn and how long and elongated it is and what your investment time horizon is.
Steve, commodity cycles are normally long. We saw it on the upside. It went for a long time, stronger for longer. Downside, historically, is even longer. What's the sign that things might be getting close to a bottom? Is it when BHP and Rio, those big low-cost operators, actually start to get a bit of investor support? Is that the sign you're looking for?
Look, I really think we could be in for 20 years here of suboptimal returns on capital because you've had all of these people make decisions at the top of the boom on a spot price and they make a 20-year investment on the basis of a price that is the spot market, and then a year later you're taking much lower prices. So everyone's now talking about cash costs. That takes nothing into account in terms of the amount of money that they've put into the mine in the past. So people are running these businesses at massively economic returns on capital. We still yet haven't seen even people accepting reality. You've got the Atlas Irons of the world restructuring their business and trying to get their costs down, and all that is going to do is drive the price even lower. So I think you need to see capacity start to come out of the market before you can get any confidence about the actual commodity price.
And closing mines. Correct. Okay.
But I do think if you can find businesses that are throwing off a lot of cash flow, even in this environment, you can get your investment back in a fairly short period of time and you get an option on things recovering 4 or 5 years down the track. I think there's some interesting investments out there in that space.
Okay, so Jeremy, we're 3 years into a possible 20-year downturn. What's the sign that we hit at bottom as a sector as opposed to individual?
On the flip side from Steve, it's about demand. So if we see that supply coming in, but we also see some signs of global demand starting to pick up, we need a synchronized pickup in global demand, and we need to see China bottoming.
Is it going to come from China, or is it going to come from India or other parts of Asia, or is it?
Just the incremental demand and base size from China is so large relative to what India can potentially add in the short term. I think it's really got to be China because there's not enough in the tank for the rest of the world to get things going. Commodity super cycles need big demand, and China's really the only source of it.
There you go. Cycles are long, and the bear is not going into hibernation for a while.